the 19th of November. Welcome my panelists, Akintunde Suleiman of Greenwich Merchant Bank, and of course, Joshua Davis, Head of Banking Analysis at Vertiva Capital Management. Gentlemen, it's great to have you. Good morning.
Good morning, boss.
Thank you very much. Let's get to look at the African markets. The equity side on a daily basis, Nigerian market came back roaring 1.68%. And say thank you to the banking stocks. Of course, Union Bank came in yesterday with 1.1 trillion naira in deposits, the highest the bank had ever recorded. Then Ivory Coast stock market finished around 0.01%. Egyptian and the Kenyan market softened, but the South African GSE up 0.47%. The South African Central Bank interest rate decisions later today. Press briefing, 3 p.m. South African time, 1 p.m. Nigerian time. The final meeting of Leseja's MPC SARB for the year 2020. Let's look at East Africa, where the numbers are coming through from the banking sector this morning. Cooperative Bank reporting net profit down about 11% to 9.8 billion shillings. Yesterday, we got news from ABSA reporting third quarter net profit down 65%. Kenyan Commercial Bank, KCB, warning its own profit could decline 25% when the numbers are released in the next couple of weeks. And the troubled retailer in Kenya, Tuskys, says it's closing additional 50 branches to keep the company afloat. Tuskys, over the past couple of months, had retrenched staff and closed a number of branches. Now, this is the latest that the retailer is trying to do to remain in business. Kenya's Securities and Exchange Commission, the CMA, yesterday gave a money manager's license to Standard Investment Bank. In neighboring Rwanda, the authorities, the Development Bank and AMI are partnering to support 2,500 SMEs in the country. And Tanzania's National Investment PLC declares 10 shillings share interim dividend for the year 2020. So the banking sector is coming into very strong play even this morning as we look at the Nigerian market space. So let's talk about the Union Bank numbers a little bit. Joshua Davis will speak to us a little bit when you look at the Nigerian market. This morning, the Central Bank of Nigeria released the country's PMI for the month of November. PMI headline figure now at 50.2 from 49.2 in October. The production level came back from contraction since May 2020, printing 51.7, but non-PMI remained in negative 3347.6 according to the Central Bank data. The stock exchange yesterday, Nigerian Stock Exchange, held its final annual general meeting as a mutual exchange from 2021. We expect the stock exchange going public to have been concluded. Joshua, let's start with the Union Bank story, and I'm going to ask Suleiman later about the PMI numbers, if the numbers from the industrial and consumer goods in the marketplace is an indication that our production or manufacturing activities are coming back. Josh.
Thank you, Watson. So I think it's first very important to highlight the sort of contrast we're seeing between the numbers that were released yesterday by Union Bank, another tier 2 lender, the second to release after Stanbic. They did quite well. Their performance was, as expected, across the board, pretty much in line. So interestingly, you saw the net interest income go up quite significantly year on year, despite the drop in interest income, thanks to obviously the fact that interest expense was significantly lower. All of these things were in line with what we were expecting. We knew that interest income was going to be pressured, but we also knew that interest expense was going to decline significantly. And if you look at, the cost of borrowing, and you look at the yield environment, you can understand sort of why that is. So that was a very big, factor. And year on year, they still managed to improve for their 9-month figures. So generally, nothing surprising there. And I think hopefully this would serve as a little bit of a bit of encouragement for investors, because if they see that a tier 2 bank is still outperforming its 2019 performance, then they'll be a bit less worried about why the bigger banks have not released. And then when you now look at what's going on in Kenya, where all of their banks are reporting 25%, 65% climb downs in profits, this tells you that the Nigerian space is very different, and a lot of economic factors that affected all these other spaces have not come to, they have not showed up in our market yet.
Come to play, yes.
Yeah. So I think it's very important to highlight that difference, to highlight the fact that there are a lot of opportunities here. Although, of course, there will be significantly lower income from trading in fixed income securities in Q4. It's quite evident now that Q4 figures for banks are going to be, quite, I wouldn't say alarming, but they're definitely going to be quite low, because all those gains, those sweet gains that we saw from, devaluation, and all those gains we saw from fixed income trading, even in the first half of the year, they're all but done for now. So for the rest of this period, banks are going to be in a little bit of a tight space. So that might be a bit of a cause for concern, but I think Q3 figures are definitely not going to reflect that, because there were still at least some marginal gains to be had in the space in Q3. So I think that the banks will start to release, hopefully, if not before the end of this week. I'm hoping by Friday, but if not by next week, we should see some more tier one banks releasing their results.
Fantastic. We appreciate your thoughts on that. Suleiman, what about the PMI? What's your take? Your first take? What's your first word on this?
Thank you, Boston. I mean, for the PMI, we're excited that we've expanded from the contractionary era. We saw inventory, however, remain contractionary. Employment levels remained at the contractionary level. However, supplies, new orders, and production levels spiked. This is no surprise, as we've seen that the industrial goods and consumer goods companies were releasing relatively, solid numbers, better than expected. And if you look at the PMI report, you say that the CBN highlighted cement, textile, food, and beverages as one of those sectors that drove that expansion. This is a positive light going forward, because analysts have been largely bearish on the expectation of the real sector, due to the fact that the impact from the coronavirus and subsequent the action we saw from the NSAS protest. But this puts a bit of light into what we should expect for full year. We expect that going forward, production activities and manufacturing activities will keep up. We pick up. Inventories will start building because production level has improved, and supplies has also picked up. However, new orders are is not picking up as fast as we should expect, because obviously consumers still battle with a tightening wallet and a slim wallet. We saw recently the spike in PMI prices that will further constrain purchasing power for investors and for consumers, and as well that will impact cost levels for manufacturers. So overall, we expect that demand levels should improve, manufacturing levels subsequently should improve as well. That should drive PMI to the expansionary level, and we expect that this will further drive GDP. We are expecting the numbers next week. It might not take us back to positivity, but we expect that the contraction will ease, and going into the full year, we'll be expecting to see relatively better numbers, and this should propel a recovery in the economy and recovery across those sectors.
Interesting reading on the PMI. Let's bring in Southern African story, and again today's monetary policy meeting decisions. Next week, Nigeria's central bank will finalize for the year. A few corporate news, by the way, from Spar, which of course we have a couple of their outlets in Lagos and I think Abuja in Nigeria. Wholesale turnover 5.6%. SAPI floating 1.75 billion rand senior unsecured bond 2025. Investec deferring half-year interim dividend until, according to the company, the market stabilizes central bank in Zambia left interest rates unchanged at 8%. So let's get your thoughts, Joshua, in terms of what you expect from South Africa. The president yesterday at the investment conference continued to speak about why the country needs foreign direct investment. The target is 100 billion. How much do you think Nigeria needs? South Africa is looking at 100 billion over a 5-year period. How much do you think Nigeria can get? How much do you think these two big economies need to do to attract investment that been seriously lagging, even going down before the COVID-19 pandemic, both for Nigeria and for South Africa?
Well, Boston, I think it's important to note that our predicaments are very different. South Africa is going through a pretty natural economic downturn that they started on that path long before the COVID-19 pandemic. So, their economy has been suffering for very different reasons to ours. And, their currency is not as tightly wound as ours, it's not as controlled. So if they say they want to raise 100 billion in FDI, the chances of them achieving that over the next 10 years or whatever that may be, I don't doubt it. But to compare them to Nigeria, the chances of us raising, a quarter of that figure is really in jeopardy due to the fact that our currency is on a downward slope, and no matter what the CBN attempt to do, anything they do, if it's just a stopgap, it's just going to continue to build up the pressure on the currency, which eventually will lead to another devaluation. Now, if the devaluations are always coming in increments and are never getting the currency down to what the foreign market believes is the true value, then it still will stifle investment, because you are chasing investments while your currency is not reflecting its true value. And they are not putting in place policies, I believe, that are going to even improve your balance of payments. So there's no way you're even going to attract currency in terms of exports, in terms of productivity. And then on the other hand, you're not going to attract export, you're not going to attract foreign direct investments, because investors are just not convinced by your economy. So South Africa are in a much better position to do all those things. Their economy might be suffering a little bit, might be slowing, or might have been slow for a while, but at least over time, we know that, economic downturns do fade. Thanks to the right policies, thanks to the right policy directions, these things will go away. However, in Nigeria, I think we're going further and further into a hole. We're trying to, in different sports, and they're just building the pressure, and the whole thing will crumble down at some point. It may not happen next year, it may not happen the year after that, but the longer it delays, the worse it will be. And that is, I think, the biggest warning that we have, is that we shouldn't feel comfortable that because our economy hasn't completely flatlined to the level of Zimbabwe, that it will not happen. Because it can happen, and unfortunately, if we continue with the current policy direction, I believe it will happen.
Okay, so one of the things that the government announced this week, just about 3 days ago, Suleiman, is to sell a couple of government assets: the National Theatre, the Tafawa Balewa Square, the Geregu Power Plant, the one in Motoshaw, Calabar, and a few other things like that. The Abuja Stadium, by the way, I'm not sure if you guys will miss that, if any major events, football match at play there. So this can as well just go away. So just to raise a couple of hundreds of billions of naira under the privatization scheme. Do you think this will be a game changer? Do you think it will move the needle of the fiscal imbalance that Joshua just touched on?
Not necessarily. I mean, the need in Nigeria goes beyond that. However, that will save some costs that has been always allocated to those facilities that were never utilized optimally. I mean, there were times where you go to stadiums and we're having parties on the pitch, which has always degraded, I mean, the value of those structures. But having said that, I think it's a great move for the government. These are stuff that have always been advised, that securitization or entirely privatizing those assets would be the joker for the government. Because if you go deep, if you go deep into the books of the government, you realize that there are a lot of moribund and idle assets across the country. Our prime locations, for that matter, are doing nothing. If you go to Broad Street, you go to Marina, you see a lot of buildings owned by the government. You come to VI, you see a lot of liaison offices owned by government and that are doing nothing, dilapidated. Because these are prime assets in prime locations that you can monetize, you can securitize, and it will help your revenue. It might not take you out of the hole you are, but it's going to boost you in terms of revenue, and it's going to save you a lot of costs in terms of allocation to for the maintenance of those assets. So I think yes, the government has started. It's a good move, but it's not what would take us out of where we are at the moment. We need more exotic means of raising our revenue. A core diversification policy and agenda thoroughly followed to the letter would drive us out of where we are.
Joshua, in line with this conversation, do you think the government should use the debt capital market or the equity capital market option, for example, to sell off some of these assets? For example, look at the Tafawa Balewa Square, for example, a very huge facility, real estate. I'm sure it runs into a couple of billions of naira. Why don't the government just have list it on the stock exchange, for example, provide value for investors, let Nigerians buy into it, for example, instead of just selling it off to some private operators. And at the end of the day, only few people get to own. It's just those private investors. It stays in the hands of these very few. Like Ghana wants to bring 18 state-owned enterprises to the Ghana Stock Exchange for listing, allowing Ghanaians to buy the shares of these companies. I would buy into the shares of the Regu Power Plant, for example, if it goes directly through that route. And to deepen the market, look at the billions of naira that it will bring onto the stock exchange capitalization.
Okay, so I definitely agree with you there that a lot of state-owned enterprises should be privatized and listed on the stock exchange, or rather just listed on the stock exchange, not necessarily privatized completely. However, I think that we have to remember something very important, is that the truth is not everything that the government has right now is viable short, medium, or long term. Now, a lot of these fixed assets, a lot of these stadiums and things that were built, they're not, unfortunately, very viable simply due to the fact that the cost of maintaining them is far outweighs any kind of revenue that they would hope to generate from the use of these facilities. Now, the Geregu power plant, you are very correct, should be listed. There are a lot of government enterprises that should be listed on the stock exchange. You know, NNPC for one. Under the PIGB, there should be a listing of whatever the new entity is. That is, our government has too many assets on its books that are of no use to it, and that it cannot even begin to extract value from. You know, there are a lot of, in fact, in Lagos, if you drive around Ikoyi or, Lagos Island, for example, you see a lot of government-owned properties, government-owned assets, some of them moribund, some of them incomplete, that unfortunately, the government just does not have the will nor the financial power to begin to complete these projects. So the truth is, some of them definitely need to be sold off. But I think it should be on a case-by-case basis. They should be assessed. The viability of them should be assessed, and then whatever value they can extract from it should definitely be extracted. So whatever it is that they decide to do, whether it's real estate, I think selling off real estate is the best option, and selling equity in is the way to go. Definitely, the government. I think this government is too big for the revenue that it generates, and it's too big for the burdens that it chooses to carry. Because I don't think we are nearly financially solid enough to be a socialist society where the government owns and controls every aspect of the economy. This government has tried it. A lot of governments have tried it, and unfortunately, it costs more than it's worth. And in terms of debt, I don't think the Nigerian government should really be looking to raise any more debt. Unfortunately, for the level of deficits it's trying to generate, it has to raise significantly more debt, both on the local and international stage. But I don't think that this is the way to go out of. I think that it just long-term for our future, it doesn't help.
I agree with you. Too many dead assets on the books of federal and state governments. They're just carrying it on the balance sheet, keep funding them through taxpayers, tax and NNPC and crude oil sales. And we just keep funding dead assets that are not productive. Look at the federal secretariat. Could be an international hotel or real estate apartments that would generate so much money, whatever you want to turn it to, and it's been sitting there for nearly 2 decades or so. I totally agree with you that I think one of the ways the government, the Nigerian government, should partner with the private sector first is to let go of these assets. I think that should be the show of good faith. Before any further discussions, just let go of this asset first into the private sector, clear, well done, in a way that Nigerians can participate in the privatization, sale, or listing of it. And then we can have further discussions down the line. But you can have trillions of naira of assets sitting on your books that are not unlocking value into the system. I know there are a lot of asset managers, investment banks in Nigeria the government can partner with to sell Ikoyi, to sell the federal secretariat to the Ikoyi, and could be an infrastructure for whatever it is. And you can just, you guys can work on the books and bring them to the market. Better managed by asset managers rather than just letting them waste away. And we keep paying salaries and things like that. But again, let's just leave it there for today. On a final note with North Africa, just a couple of stories to touch on. The Afrexim Agri-Commodity Index printed higher 13% in third quarter. Suboptimal weather conditions, according to the report released on Wednesday. Bank of Cairo is looking at £1 billion investment for SMEs. The way to go. Misr Bank is cutting its stakes in Rwanda tourism to 9.48%. Again, tourism is in the water, no thanks to the COVID-19 pandemic. And Tunisia Stock Exchange says all the listed companies, their overall income so far this year down 5%, again because of the pandemic impacts around the world. Thank you, gentlemen. Joshua Debisi from Vetiva Capital and from Greenwich Merchant Bank, Aketude Suleiman. Thank you so much. Have a great day. We'll see you again tomorrow. Bye for now.